Good afternoon, everyone, and thank you so much for being here today. This great Fibonacci and Elliott Wave uh, symposium is just incredible. And today I will talk again about Fibonacci's, and I'm going to scale in a little bit into Elliott waves. I do use some kind of Elliott waves. We're going to get into it in just a little bit. But first of all, learn how to trade institutional levels using the predictive power of Fibonacci's, which is incredible. Finding the best entries and targets, finding your risk level, and also it's helping you a lot in trailing. So I do use Fibonacci. It's not the only thing and the only element, the only technical analysis tool that I use. Throughout these 3 days, you're going to hear me mention a multitude of technical analysis tools, but today we're going to focus more on Fibonacci's, and then we will like more and more into an Elliott wave or a hybrid of the Elliott wave that I'm using. All right, so for those of you guys that are here, the information that I will be providing today is for educational purpose only. All right, so for those of you that are new, oh my gosh, and I see so many new people in here. It is just crazy. I see a bunch of numbers and then I see some names, okay? But it's the way the system worked today, and hey, technology is something else. But anyways, for those of you that are new here, I want to welcome everybody to this highly technical conference, and I love technical analysis. In fact, technical analysis represents about, I would say, 98% of my trading, and only 2%, about 2% is fundamental. So for those of you that do not know me, my name is Anka Metcalf. I am the CEO and founder of TradeOutLoud.com. I teach traders how to generate income every single day in 2 hours or less and create your own wealth ecosystem. That's what it's all about. I'm a professional independent trader. I'm focused on equities and futures. In fact, I have been trading Forex. I have been trading equities for a very long time. And then I transitioned into day trading futures about 10 years ago. Full-time, only 2 hours a day, even less than 2 hours a day. And this is what I specialize in. Also, I trade equities, I swing trade, and I actively invest in the markets. In fact, we do have 2 programs that are available. One that is a day trading room where you get to trade with me and carbon copy my trades in the futures trading room. And in the stock swing trader, I call swing trades and also investing opportunities, but that is for stocks and ETFs. Prior to becoming a professional independent trader, I come with 10 plus years in investment banking. Like I mentioned before, I'm the CEO and founder of TradeOutLoud.com, which is a trading education firm that is specialized in educating individuals how to day trade, swing trade, and actively invest in any market and in any market condition, whether it's stocks, ETFs, futures, forex, anything, cryptos, you name it. If it moves, if it can be charted, it can be traded. All right, so I focus on high velocity moves. So what that means is that I use a confluence system, amongst which Fibonacci is one of them. Elliott Waves hybrid is one of them. And I do use other 6 actually layers of price support resistance that enables me to identify trades with a really high accuracy. In fact, I do have a win ratio of over 80%. So last month, I believe I had about 70%. And of course, it's the market conditions that is creating this, or I think it was like 73 or 75%. I can't remember exactly, but anyways, it's way above 70%, which means that I win in 70% of the trades, only lose last month, for example, in 30% of the trades. All right, so obviously you'll come ahead out of this thing. So you can see how this system is impacting my trading activity. I'm also the designer of an institutional proprietary trading system. What this means is that I'm not the creator. I did not invent Elliott waves. I did not invent the Fibonacci sequence, right? So what I did was I actually created a system for myself. This is the system that I created for myself to actually be able to forecast trades using these, let's say, technical tools that everybody should have in their toolbox. And the system is based on price support resistance. And like I've mentioned, there are 8 layers into this system. If you're only focusing on price, supply, and demand, then you're missing like 80% of the equation, because the 80% is what actually is going to turn the balance in your favor. I focused on specific trigger times, and that is for day trading, because you could use Fibonacci's for day trading. You can use them for swing trading. You can use them for investing. I'm also using specific price zones, and in this webinar today, I'm going to focus a little bit more because we do have an offer for the trading room at the end of the presentation. So I'm going to tell you a little bit more about the trading room and what it does and what it can do for you and your trading. So I trade with specific price zones because there are specific 4 precise price zones on any kind of technical chart, whether you're using futures, whether you're using stocks, ETFs, or whether you're using Forex or cryptos. There are these 4 specific price zones that are going to show you where institutional traders are legging in, because as you know, they buy in bulk, right? So what they do is they scale in because they cannot buy, for example, like 100,000 contracts at once. So they're scaling in either 5 contracts per minute, or they're scaling in 25,000 contracts every 15 minutes or so, and they're doing it at precise zones. All right, so I also have developed, because I have been trading for such a long time, for over 20 years, I have noticed that there are times throughout the day where trades don't seem to work, and other times when you have a more powerful trigger point. So I have developed specific trigger times for the timing, and tomorrow I will talk a little bit more in depth about these trigger times that are happening within the sequence that I trade in within these 2 hours. And this is an Elliott Wave hybrid price action that is actually put together with timing. It's just so amazing, and it's super simple to use. You don't need any kind of expertise in order to use it. So tomorrow you're going to learn something new. I also am very focused on chart synchronicity and divergency, because, you know, at times you may have, for example, NASDAQ that is stronger, and you have Russell that is weaker, or you may have a stronger S&P and a weaker Dow. So at times, you know, not all the indices are moving in sync. Today's going to be, again, one of those times where they're kind of like moving in sync, although you do have some you know, relative strength, for example, in the Dow, in the M&E S&P that are holding the 10 AM lows. And for example, you have a little bit more relative weakness in RTY. But anyways, bottom line is that I use a multi-time frame correlation. And in fact, you have heard Jody before of me, you know, mention that you need to have this correlation between time frames, especially when you're day trading. So I'm in line with that. I totally have, you know, kind of like respected that in my trading. So for example, you need to have this communication that is ongoing, for example, from the 2-minute, the 5-minute, the 15-minute, and time frames and patterns need to be rolling in or rolling out depending on whether you're long or short. So first you're getting a 2-minute setup trigger. In about 3 minutes from then, you're going to get a 5-minute rotational trigger. And then from another 10 minutes, you're going to be getting that 15 minutes. So these are the approximate time frames. So the pattern is going to be rolling in. So that is also a great opportunity, you know, if you want to scale in. But anyways, bottom line is that I also use the Elliott Wave, and that is price action reaction into the Elliott Wave context, depending on which segment it is trading in. That allows me to forecast. I do use moving averages that you're going to hear more about tomorrow. And I do use major and minor support resistance plus the timing. These minor support resistance, these are the hybrid that are derived from the Elliott Wave. All right, so let's continue. If you guys want to learn more about Trade Out Loud, you can definitely go to our website and find out more. We're also on social media. But hey, before we jump right in, don't you feel that, is it like awesome that money is energy? Have you noticed the power of energy? Have you noticed the powers of the power? Yes, it can be applicable to options as well. It can be applicable. So all these systems that we're talking about today, not only myself, but everybody in here, even if they're referring, for example, for day trading futures or for swing trading stocks, or whether they're referring to anything, any asset, when it comes to Elliott waves and when it comes to Fibonacci's, there are applicable 100% for options, especially for options. All right. So guys, money is energy, right? When you have high energy, right? Money comes to you, right? Money comes to you. If I come in the market every single day in the trading room and I go like, oh, you know what? Today's right after a long weekend. Let's see if we can have a trade. It's like you don't have the energy, right? You're not literally focusing enough, because when you focus, you bring on the energy to you. So I think that before we get started with anything else, and diving into Fibonacci's, I think the most important thing is that to recognize that money is energy. And also there's another thing, income. Wealth, right? Whether you're trading for income or whether you're trading for wealth. Trading for income is day trading. You're in a market every single day. You're in and out. At the end of the day, you have all your positions closed. That is income. At the end of the day, I could take my profits, either go to McDonald's, or I could go to the finest restaurant, or I could go to Best Buy and buy whatever I want. Wealth is when you don't have access to your money every single day, because they're invested into the market. And when you have your money invested into the market, you do not have access to your cash at the end of the day, at the end of the week. So you have to wait for a certain period of time, whether you're out of trades or you want to typically, kind of like, wait it out. So income and wealth is a high energy result. Money is energy. Money is in and out, in and out. It's always in motion. And therefore, your knowledge needs to be in motion as well. Now, as you probably know, oops, sorry about that. As you probably know, I just lost the chat box for a second. Sorry about that. Fibonacci is the number sequence that is naturally present within nature. Spiral galaxies, right? Spiral galaxies such as the Milky Way, for example. The distance, let's say, between planets. Seashell spirals, you could see them right here. The formation of hurricanes, the growth rates of plants, quasi-crystal arrangements, for example. Another thing would be like reflections of light beams on glass, or petals of flower, or the way the seeds are displayed within the core of that flower. The brain, even the nervous system, and yes, even the DNA molecules that make up all living creatures are just very few examples of how the Fibonacci sequence or the golden ratio is present in nature. So I actually took out a few slides because some of the presenters before me already talked about it. So I eliminated those slides. And actually, you know that the Fibonacci sequence is 1 + 1, right? And then you get to, so you're adding the two previous numbers just to have the result as a Fibonacci number, and then you take that and you add it, and this is how the Fibonacci sequence is created. But have you noticed that there is such a strong correlation between the Fibonacci sequence and technical analysis and the market? Have you guys noticed? Now, how many of you guys can count to 3? How many of you guys can count to 3? All right, how many of you guys can count to 3? Give me a 1 right here if you can count to 3. Seriously, I am not kidding. Let me know. How many of you guys can count to 3? All right. Okay, so not many. I know it's not a trick question. All right, how many of you guys can count to 5? Count to 5, right? I mean, it's as easy as that, right? We're used to. All right, how many of you guys can count to 8? How many of you guys can count to 8? What if I told you that if you know how to count to 3, you can trade? How many of you guys know that if you know how to count to 5, you know how to trade? And also, how do you guys know that if you can count to 8, you can trade, right? So let me share something very amazing with you, okay? All right, so the number of bars in the sequence, I'm just going to pull this chart up. I hope that you guys can see it, okay? So every single time you get a pullback of 3, 3 is the Fibonacci number. After you get a pullback of 3, you can expect a pullback to happen. And then you go by the strategy that you're applying within the Fibonacci sequence. So for example, here we have 1, 2, 3. This is actually the spies, right? Here it is a little larger so you can see it. This is the spiders, right? And when you have, for example, a 1, 2, 3 pullback, you can expect a rotation. So if you have a total rotational point off of the 3, right, you count 1, 2, 3. And when you have a green buildup, let me see if I can take a cursor from here and show you guys. All right. So for example, throughout the week, right, we just started the week, is just still very early. There's still lots and lots of time, and you can review this recording into the end of the week to see if it played out. So I'm going to show you 2 opportunities that can happen here. Number 1, you get this bar right here throughout this week. This is a weekly chart, by the way. So one candle represents 1 week of trading activity. So if you're getting a rotational pattern that is going to take out last week's high, which will not be that hard, right? So if we take this high over here, well, I did it a little bit higher, but it's a little bit lower. You can see where the high is. Then the pattern is going to go where, guys? It's going to go higher. So there you go. Without even knowing, you're trading off Fibonacci numbers. Okay. So this would be the higher low within the context of a changing of the pattern, changing of the guard. So instead of the downtrend, because you can see that we have a very strong channel going down here. You're going to have a change in the trend. This is the channel, right? And this is the fight right now for either a continuation lower, probably into the 360, or the rotational pattern. If this is going to play out into the end of the week, then we will have a rotational pattern and the price action is going to charge higher. However, it is still fairly possible that we can have, for example, a doji candle right here. How many of you guys know what a doji candle is? A doji candle is a candlestick that looks pretty much like a cross, where the open and the close are overlapped, and you have a high and a low, and basically you have no domination for the bears or for the bulls. They're completely neutral. Okay. So Danny, the 1, 2, 3 is the candlesticks. 1, 2, 3. You can count the candlesticks, right? So you see candle number 1, candle number 2, candle number 3. You can't get it any easier than that. Okay. You cannot get it easier than that. All right. So this is number 1 that I wanted to share with you right now, just a little bit of, and this is what's happening now into the market. It is September 6, 2022, 3:21 p.m. Eastern time. And there are 2 possibilities. So number 1, we get a rotational point from that 1, 2, 3 bar down, right? Because we have 3 weeks, 3 consecutive weeks, we have been down. We either get a rotational pattern this week, or we are neutral with an inside bar on the weekly, which would typically suggest bullish above, for example, this week's high, or continuation for the bearish below into that completion into the 360. If that's going to happen, and if we have a continuation, I'm going to put this back on. And if we have a continuation back lower, all right, let me see if I can do it. Then we are going to have probably another 1 or 2 candles back to the downside. And this would put it into a 1, 2, 3, 4, 5 situation, which would be cone completion back into support, right? This is going to be the support for the area. So you can see that there are a lot of similarities between the Fibonacci sequence, right? The Fibonacci numerical sequence, such as the 3, the 5, and the 8, and the number of bars into the retracement, right? Isn't it cool? Isn't it cool, guys? And it's fairly simple. All right, so I'm going to put this chart back up. I'm going to show you something. We had a pullback within the trend right here, right? We have the pullback into the trend. We have 1, 2, 3, 4 pull back into the 20 SMA. Then we have the rotational point. Then we have 1, 2, 3, 4, 5 green candles to the upside. Okay. Here we had 1, 2, 3, and then a little bit of pullback, right? So here we had 1, 2, 3, 4, 5, 6, 7, right? So we have, if you know how to count to 3, 5, or 8, you can anticipate a pullback, a healthy pullback on any time frame. So the chart that I showed you guys was on the weekly, but typically when you're looking for a pattern, because everything is technical pattern, everything has to have a price confirmation, everything has to have price evidence, right? You don't just buy at support or sell at resistance. That is what amateurs do, right? You don't want to be that trader that followers say, oh, I'm buying on support. What is support? Is the last shelf of defense before another big drop down, right? So your odds are going to be very slim if you buy off support. If you buy support into an ongoing very strong trend, even then you may have a further retracement down. So once again, the Fibonacci numerical sequence is especially number 3, 5, and 8 is present on technical charts on healthy pullbacks. Any kind of healthy pullback comes with at least 3, 5, or 8 bars into the next support level, or a support level that is later developed by price action. Then we have some other numbers in this sequence. We have 21, 34, 55, and 89. I use the 21 simple moving average. 34 simple moving average, I don't use it right now, but I use it in highly volatile markets. The last time that I used it, it was in 2018 and in 2020 when we had the pandemic pullback, and then we had the extreme volatility in 2018, especially towards the end of the year into the last quarter. I use the 50 simple moving average because, as all traders, everybody seems to be rounding up, and 50 seems to be the norm with institutional traders, and I still use the 89 SMA. So I do use these moving averages. This is how they're represented on my technical chart. I don't have the 89 right here because I have it on my other charts. This is my work day trading chart, and I don't have the 89 on my day trading chart. So I use the 20 SMA, the 10 EMA, and the 50 SMA, 200 SMA as well, the daddy of all moving averages on my technical charts. And like I said, I do use another moving average. I'm going to show you right now so you guys can see that I'm using it, not just telling you that I'm using it, for example. All right, so this is yellow line right here is the 89 SMA. This I use for swing trading, for investing, etc. Okay. All right, that's my home screen for my platform. And then again, we have the 144, 233, and these are numbers, these are percentages for the extensions, for the retracement. These are numbers that are calculating your extension and retracement that we're going to be talking about today, and show you how awesome they are. But there's a catch to using, because I know everybody's talking about Fibonacci's, but the main and one of the most important things is, like, what is the time frame that you use Fibonacci's, right? Do you use it on a 1 minute chart? I mean, yeah, there are traders that are using it on the 1 minute chart, but let me tell you something. By the time you trace it on a 1 minute chart, the move is long gone, because you have to be focused more on price action. So you have to have it really traced, and sometimes you don't have that time and that luxury. I use it on very high time frames. I use it on weekly charts, monthly charts. I use it on daily charts, and I stop at hourly charts. There are only some periods of maximum volatility in the market that I would apply it on 15-minute chart. And that is when, if the Dow is going to be 2,000 points down or 1,500 points down, that's the only time when I'm going to be using it. This works for me. I have been trained to be working with Fibonacci's this way. All right, so now that you guys know right now that, you have the retracement, right? So how easy is this, right? Because you're waiting for a pullback of 3 to 5 candles, right? Or 8 candles into some kind of support or resistance, right? Because whether you're long or short, I mean, this is a no-brainer. 3 to 5 candles into a moving average, Fibonacci numbers on the candlesticks, Fibonacci numbers on the MAs, right? All right, what else do we need to know? Well, traders use Fibonacci analysis to predict how far the price action might retrace on a given move by looking at the prior highs and lows of the previous move. Guys, of the previous move, this is the most important thing. So when you are tracing Fibonacci levels, make sure that you identify a previous pivot low, most recent low, and a most recent high. And that recent high, for example, in an ongoing trend has to be fully formed. It means that it has to have that pivoting formation. So it needs to have that V formation, that sell pattern on top. Because if the price is still ongoing, guess what? You're not going to be able to trace any kind of Fibonacci. So for example, when I'm showing you this chart, I can trace a Fibonacci from this low to this high right here. But can I trace it from this high to this low right here? No, that would be completely stupid, because I need to have a pivoting action. So unless I have, for example, a candlestick that will actually trace and retrace, and that will retrace, I'm trying to get my cursor here. Okay, here it is. So unless I have a candle that is erasing this prior high and it's forming the pivoting reaction right here, then I cannot trace it from this high to this low. All right, I cannot trace it. The only way that I can trace the Fibonacci now would be from this low to this high, because these pivots are fully formed. Okay, so if I do that the way I do it, all right, so I shouldn't be playing with these tools because I almost shut down my screen. All right, so here we go. We go to Fibonacci's. You identify the trend, you identify the pattern that you want to measure. So what you do is you go to your Fibonacci tool, you trace it bottom top, and therefore you have right now a possible retracement. You can see why the price action is not having a lot of velocity to the downside, right? You can see why it's sitting on the 61.8%. Now, a lot of you guys may know what that means. That is the golden means, and more about that in just 1 second. All right, so the market is defending right now. Price action is defending that 61.8%. All right, so by looking at the prior highs and lows of the previous move, traders will use Fibonacci retracement to determine how far a current retracement in the asset might last, right? So now we have what? We have candles. So we have 1, 2, 3 into a golden ratio, right? We also have the price action that may trigger a rotational pattern based on the 61.8%. So what is that 61.8%? This is considered the golden means, is the Lamborghini of your Fibonacci tool, right? It's the Lamborghinis. It's the, like, I don't know. It's you know, just so important. It is an institutional level. All right. Wow. Okay. So 50% retracement is considered a medium retracement. And just so you know, a 50% retracement is not a Fibonacci number. It is just a measured move between a swing high and a swing low, right? It's between the swing high and it's just half of it. You could actually eyeball. You don't have to really retrace it on a technical chart, because if you have been trading for a while, you really don't need it. Once it's getting into that 61.8%, guess what the price is going to do? Pop up, pop, pop, pop. It's going to try to pop up. And if you have the environment good for that, then it's going to try to hold that area. If it's not going to hold into the 61.8%, it's going to start retracing lower, and you have a level for that. Also, the 38.2% is considered a shallow retracement. I'm also going to share with you the significance, right? Because hey, there's more other levels, right? So what are all the other levels on this Fibonacci sequence, right? So we have the 100%. This is where we started, and this is where we traced it to, right? Because we have a pivoting formation here, we have a pivoting formation here, and we also have solid resistance on top. We have the 50 SMA, and we have a rotational point. So that made it a really nice, strong pivot. So at this point, the yellow line that you guys see here, that's the 23.6%. This is called a news line. This is called a news action. For those of you that have been trading for a while, for those of you that have been trading in 2008, not 2008, but after the financial crisis, like 2010, 11, 12, 13, when the market was into its QE years, quantitative easing years, the market was literally flooded by money getting back into the market. Money was getting printed, and the price action was going higher, and any kind of retracement was very shallow. Why? Because once you had an FOMC meeting, right, they would pump more money, print more money in the market would go higher, and then close to the next FOMC meeting, the market would retrace because they didn't know whether the Fed was going to print more money. So that retracement came into the 23.6% almost every single time. And it was very easy to trade then because you pull back, boom, set up, confirmation, and buy. The other element of the retracement is the 38.2, which is a little bit of a steeper retracement than the 23.6. This is called the magnet. This is the magnet area. So when it pulls back to this level, if this level is usually a level where you're going to have confluence. So if you have been, for example, in an uptrend or even a counter trend, you're going to see that you're going to have some other elements on the chart that is going to line up their technical elements. And then we have the 50%, which is not a Fibonacci retracement. It's just the middle of this whole progression from low to high. And then we have the 61.8%. This is the golden means. Institutions love it when you're getting a much steeper retracement. In fact, if you were trading, like in the 80s, or if you're trading right before, let's say after the 2020, and we're going to talk a little bit about, the year 2000. Almost every single pullback came a little bit more steeper into the 61.8%. Institutions love this area, and algos love this area. If this level is not going to be holding, and by the way, this is a weekly chart of the SPYs, right? So we're talking about macro projection, because even if you're a day trader, you have to look at potential swings to the upside or to the downside when you're prepping for the week. So if we break the 61.8% retracement, then we're going to slide to the next one, which is called the danger zone, which is into the 79.6%. And this retracement is a little bit trickier, because at this point you would have retraced 3/4 of the move from the swing low to the swing high. And if this level is not being defended, then you're hitting into the next level, full cone completion, which means that you may switch into a bearish context from that point on. All right, so here it is. This is exactly what I was telling you guys about. This is the SPX I showed you in the SPYs. This I took this snapshot actually, I think less than an hour ago, and you can see it right here. The SPX is also trading into the 61.8%. So this is going to be a reactionary area. You can see a lot of indecision that has been going on within the last 3 hours. And of course, right now, it's not really going to be a definite, decision into the market, because we are coming off from a long holiday weekend, and we have very low volume into the market. In fact, lower than average volume in the market right after a long holiday. The big boys are still probably in the Hamptons or anywhere in the world, still partying. And I think that we're going to get back into a little bit more action next week. So not this week, last week and this week, just a little bit to the slower side. Here's another example of how you can use the same Fibonacci tool to actually forecast future targets to the upside, right? So for example, if you have an asset that is going to, let's say, trade at all-time highs, or it's really close to its all-time highs. And if you're, let's say, on the swing side, or even on the day trading side, or on the investor side, and you would like to see that rotation that, for example, triggers and starts continuing and starts moving higher, you want to know a measure. You want to find out a measure move, because institutions are all about measure moves. They're not going to risk their, for example, their risk unit, the allocated risk unit, unless they know the possible target area, the possible reward zone. And you're going to see that every single time this works clockwise. So for example, throughout 2020, when we started that very, very, very sharp reversal in March. And then we had, and we're going to talk about that. And then when we had, other types of pullbacks, and we started trading into all-time highs, because we were trading into all-time highs in February of 2020. Before February of 2020, institutions needed to know and say, hey, where is, for example, the SPX going? Where is Apple going? Where's Google going? Where's Tesla going? Where's M&E Nasdaq going? Where's, I don't know, whatever stock or ETFs, where are their price targets? So this is the only way that you can do it. So you do it a little bit in reverse. So for example, once you have a bull flag formation, you click the high and the rotational bottom, and you're going to find out that the tool is going to extend. It's going to project some more lines just above the prior high. All right. There's a lot to talk about here. We actually teach this in our course, and we actually take one day to explain Fibonacci's. So Fibonacci basically has a double functionality. It retraces so you can find out further pullback areas, and it also gives you the projections in case, or this is another good thing, in case you have a really wide tradable void. So for example, the distance between your entry and your target is so wide that you need additional targets. Then you can use this Fibonacci projections that is going to provide you with alternative targets all the way into your tradable void area. So it has double functionality. So just the projection alone, it shows you targets beyond all-time highs, or it shows you targets that are set into potential wider tradable void. So is Fibonacci enough to act on, right? So this is a really good question. And the reality is that it is a really powerful tool, but it's not enough. So you're not going to start making money if you just learn how to use the Fibonacci's, right? Because in order to apply Fibonacci retracement, you need to know, number one, how to read a trend, how to read a counter trend, and how the how a rotational counter trend functions. So for example, right now, let's say we're in a downtrend. You need to know how to read a potential change in the trend, because that is where the money is. That is where the institutions are legging in. So Fibonacci is a technical indicator that uses pure price action. And that's why I love it, because I'm a pure price action trader. Can be applied on any instrument, predicts rotational points. So that means that doesn't predict a buy area or a sell area, but it predicts an area where the price action may turn around, whether up or down. It predicts targets. We saw that from the projections and also from the retracements as well, depending on which side of the tape you are taking the trade. The trader must have a really good understanding of the trend. Like I said, can be used in uptrending markets as to predict new highs, and it can be used in downtrending markets to predict new lows, but it's not applicable to all market scenarios. Just so you know, not applicable to all market scenarios. So in a sideways market, you're not going to have much use from any kind of Fibonacci. And this is where a lot of beginner traders are getting stuck, because you have to have a really good understanding of the market structure. And only when you do, then you can apply Fibonacci's. So trading is a system. So it's not only about Fibonacci, so Elliott waves, it's not only about moving averages, not only about price action, it's literally a system. It's a very complex system. It's about strategies, management, mindset, experience, attention to detail, multi-time frame analysis, and multi-time frame reading. And it's how fast you analyze and process all the information so you could get your trade in, especially when you're day trading. So trading is an art of putting everything together and fast. So the first thing that you need to do, first of all, you need to gather your intel. So trading is much more than using two tools, like I said, than like Fibonacci's or the Elliott waves, right? They can help, but they're not going to give you like the totally winning formula, because you need to know candlesticks. You need to know the interpretation of candlesticks and the language of candlesticks, because that is going to give you like almost 75% of the odds. Trust me, within a sequence, whether you're using Fibonacci or Elliott waves, it's so important. And I'm going to show you some examples. For example, right now with Tesla, All right. So before even tapping into the tools, the trader needs to master the basic key concepts as starting point, understanding trends, what defines a trend, how to read and anticipate a change in the trend, understanding price action and reaction to basic support, resistance, location, understanding candlesticks and the psychology behind each shape of the candle, setups and strategies applicable to key zone, and determining laser sharp entries, what represent literally the entries, right? So when you're talking about trends, right? Trends have, for example, uptrends have higher highs and higher lows. This is basically Elliott wave, right? You have the A, B, C, D, right? And you're having it into ascending pattern. And then when it's downtrending, then you have the lower lows and the lower highs. So you have your A, B, C, D pointing down. And they're usually these are the rotational points where you can expect a much larger move to the upside or to the downside, depending where you are in the frame. The goalie and what traders want, guys. Oh my gosh, give me the holy grail. Give me that one magic indicator that is going to apply it to your technical chart. It's gonna hit a green button and say, okay, take the trade here. Okay. So technical analysis allows you to trade with precision any instrument. Can be used on any time frame, whether for day trading, swing trading, or active investing. And you guys know your time frames. For day trading, I use the 1 minute, 2 minute, 5 minute, and 15 minute. This is my zip code for day trades. And what I do is that I don't sit on one time frame. So I use the multi-time frame alignment. So for example, not only that, but for example, in the morning, there is a time sequence, for example, like first 15 to 20 minutes that I focus on the 1 minute. And then I ditch the 1 minute. I still have it on my chart and roll into the 2 minute, because you have to make sure that you're in sync with the timing of the market. The market doesn't respond on the 1 minute, doesn't respond to the 1 minute chart throughout the whole entire day. So if you're a trader that is stuck, for example, on one time frame from when the market opens until it closes, that is when you're missing out. Because, for example, the price action is very active and the market is very active in the first 30 minutes. And that is when you have to have a really good blend of 1 and 2 minute skills and patterns and a set of strategies that you're going to be applying, and you're going to be literally hitting the buttons. But after a certain time, you're going to focus more on other time frame, right? For example, from 10 o'clock, focus on 5 minutes. And from 11:30 or 12 o'clock, you want to focus on the 15 minute. Why do you think you're going to focus on the 15 minute during lunchtime? Because you're hitting the doldrums. What happened during the doldrums? Volume goes down. What happens when the volume goes down? Well, when the volume goes down, you're more likely that you're going to see a lot of traders that are going to be, going to lunch. They're going to be killing their trades. The market is going to become a lot more fleecier. So by ruling out smaller time frames, you're giving yourself a chance to still be in the trade by applying a little bit wider stops. There's a logic behind all this. Eliminates stress and fear if you know how to handle technical analysis, and you can trade with clarity, and creates focus and helps you with pattern recognition at precise locations. So how many times have you been in a trade that triggered and then stopped down? Okay, a lot of times. Okay. How many times have you found yourself chasing trades? I hate when people just go, oh my God, look, it's going up, 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 up. There's that fear of missing out. They jump into trades just to find themselves that, oh my God, I just bought the top, right? Or I just bought the bottom. How many times have you stared at the screen, not knowing what to do, and say, oh my God, just God, please show me a sign. What am I supposed to do here, right? How many times do you feel lost, not knowing where to enter the trades, where to exit the trades, what your risk is going to be? That is because you don't have a really good handle on trading in general. Because if you have a rule-based system, if you're very, very educated into technical analysis, candlesticks, price action patterns, you're going to know the answers to all of these questions. So last, how often do you find yourself in a trade in the middle of the news announcement because you don't even know what you're doing in the market and you haven't checked your economic releases? So the bottom line is to keep it simple. Time to simplify your trading, eliminate the noise, apply a systematic approach to trading. That is literally a mathematical approach, but here's the catch. Without having math involved, but having like that laser shot mathematical approach without being a math whiz. determining entries in minutes and hours, even in advance. That's what we do in the trading room. So what is the difference between technical analysis and indicators? Well, technical analysis is going to show you natural price action. Very few technical indicators will pinpoint, high accuracy entry stops targets available for free on any kind of platform, and it's free at no cost. Now, indicators, they're lagging, they're always delayed, right? Because they're based on past price action. So monthly subscriptions are required, right? Or sometimes you got to pay up front for an indicator. There are companies out there that's what they do. They sell you indicators. They're in the business of creating indicators and selling it to you in the hopes of you buying them. And so that means more cash for them. But are these indicators going to make them money? Do they have a track record showing you how much money they have made with the particular indicator? No, they're on the roll of creating the next best thing. And they love to sell dreams, right? And selling dreams works for salespeople. The only people making money off of these indicators, and I don't have anything against indicators, but are the people that are selling them. So technical analysis is a rule-based system. It helps you guys identify trades in advance with a very high degree of accuracy. In day trading and forecast entries in minutes before entries, I do this every single day in the trading room. We forecast the trades. We talk about the opportunities and possibilities, about the entries, the stops, the targets, and everything. In swing trading, forecast entries days in advance. For example, we talked about a forecast a few minutes ago in the SPYs because it's trading on the 61.8%, and I already gave you two options of what's going to happen. So based on those two options, I know how to position for a trade, whether long or short. So I already have one long in mind and one short in mind with the levels in the SPYs right now. And also for core positions, trading forecasts weeks in advance or even months in advance. So that is so cool. You do not need to have superpowers to use to identify setups, and you're going to be really well equipped. So technical analysis gives you superpowers because you're going to be able to forecast where the trade is going to pull back to. If it's going to do a rotation, then it's going to go higher, for example, in an upturn. But if it breaks that support zone, it's going to go lower. So then you're going to position yourself for a short. All right. Now, let me tell you something really cool. We're going to get back to this slide a little bit later. I hope we have time. But I want to show you something very interesting, right, in the market. So this is something that happens all the time in the market. And in fact, you could see that there are periods of massive uptrends like we had from election 2016 to about to 2018. This is the peak in 2018. You can see the number right here. And we always had areas of difficulty in the market. Some traders right now that are just starting trading, they go like, oh my gosh, this is so hard. You know, like, and yes, I agree. It is hard. This is not an easy environment. This is an environment for a really good trader that has a really good handle on the market. In this kind of market, everybody can make money, right? And anybody can make money. This is like this pure ascending channel to the upside. But every single time you saw that, we had growth concerns here in 2015. We had also in 2016, how many of you guys remember Greece defaulting? We had the China interest rate back in 2015 as well. We had falling oil prices in 2016. We had Brexit as well in 2016. You had the U.S. election and the end towards in November 2016. Then we had inflation fears, North Korea fears, we had Syria fears, right? And this was the 2018. You heard me mention the 2018 volatility. This is how it was in 2018. It wasn't an easy environment either, right? And in fact, there are a lot of similarities between what we have then and what we have right now. And then 2020 came with the Black Swan, right? Black Swan, and we had the massive pullback that took the price lower, and then we had the rotation higher, right? And this fast tracks, right? This is the coronavirus with the Black Swan event. And then you can see how the market pushed higher. You can see that it's trading above the prior high right here. There's a system that you can predict exactly, like I said, using Fibonacci's. I hope we have enough time today so I can show you how it's done to predict the possible new highs, and you will see how they went exactly to the areas. And then this is the current market context right now that we're trading in. This is the 2020 rally above the all-time highs that we had in 2020 in January. And of course, look at the huge move that we have. This is actually the first retracement that we're getting. And in fact, this is the first confirmed downtrend that we are actually having since 2008. And I know that in 2020, even on CNBC, there were people that were saying that came on and say, oh my gosh, this is a downtrend. No, it's not. Structurally wise, this was never a downtrend. It was a black swan event. It was never a downtrend. The technical pattern never showed any kind of signs that we are into a technical downtrend. We were never in a technical downtrend. Now we are in a technical downtrend, and you have the Fed rate hikes. You have the energy crisis, especially hitting hard Europe. You have inflation. You have the war. You have everything. Everywhere you look around, there is a crisis in Iraq. There is a crisis right now in Syria. There's a crisis everywhere. Not speaking about that Ukraine war, right? All right. This is the retracement as well. This is a weekly chart of the SPX from the pandemic low, right? This is the pandemic low. So this is a different retracement. So from the pandemic low to the high that was this year in January, in the third day of January, this is the huge move that we have. This was the AB, if you will, that we had into the market, because that's another way of looking at it. We're going to talk more about this tomorrow when we are going to talk Elliott Waves. But anyways, this is the high right here. This is the downtrend that I was telling you guys about, and recognizing when you have a downtrend, because that's the big doozy. Nobody knows how to identify a downtrend and an uptrend appropriately. So a downtrend is when you have a high, two lower lows and two lower highs. Boom, 2 + 2. You have those, you have immediate downtrend. You apply this technique on all your charts and all your time frames, and you're gonna ace reading trends into the market. So when we look at this chart, we see that we have here just a highlighted area. Right here is that 50% retracement. Here's that 61.8, and here's that 38.2, right, percent. So here is the interest area. So if the price is going to start pulling back, it's not going to pull back much, at least the first signs that we're having right now. So the first thing that we're looking is that 1, 2, 3, and whether we're going to get a weekly rotation at this point. Conviction. You need to have conviction to enter trades, to stay in the trades, and know when to scale out and know when to exit. I don't only use Fibonacci's. I don't use just Fibonacci's. I use a blend of moving averages, volume. I use Fibonacci retracement and projections. These are the levels that I'm using that we talked about. So now here, after this, I'm going to try to see if I have a little bit more time. I don't know, but I'm going to show you something really cool that happened since 2020 that freaked everybody out, and it proved to be like super well calculated. It's the best, let's say, back testing of Fibonacci's that you could ever see. So first of all, we have the futures trading room, and this is what I am promoting today. If you guys don't have a game plan, if you're losing money in the market, if you don't have a system, if you don't have a process that eliminates noise, if you're not trading stress-free and you're not having fun when trading, if you don't know what risk is, if you don't know how an entry is, a rotation is, if you don't know how to apply technical analysis, this is the place for you. Or if you know how to apply everything, but you just need a holding hand, that somebody that is going to, do the analysis for you, somebody that is going to call trades for you, somebody that is going to trail trades for you. So it's basically doing all the work. I am doing this in my trading room. My win ratio is over 80%. So included with the trading room, you get the pre-market game plan every single day by 9:30. I usually start around 9:20 to 9:25 lately because of the market volatility, and I need to have more price evidence before I get on the mic. We trace institutional levels, for example, for futures. So we know when to be bullish above or bearish below, or what the area may be. I'm going to show you just a quick image of the trading levels that we had for today. This is bearish below, this is bullish above. This is confirmation that we're going to go all long, and shorting is not going to be an option. This is going the confirmation that we're going to go short, and going long is not going to be an option. We had 2 trades today, by the way. Both worked really well. They worked alongside with the market momentum. you get real-time precise trading, and you get 100% guided trading. That means that if you don't have a method, and if you don't have a track record of taking trades on your own and making money, you could just take my trades. I take between 1 and 3 trades a day. I call the exam parameters entry, stops, targets, and also much more than that, I trail it for you. So not only that, I'm gonna have them on the mic, call them on the mic before it happens, because I have a method of anticipating and predicting price action momentum based on technicals. But you're also going to get the typing. So I have time to type it in the trading room. So you have plenty of time to take the trade with a limit order. And also you have real-time response to all your questions. Obviously, I'm not taking any kind of question in the first hour because I am trading. My first objective when I come is to make money for myself, right? And then I'm sharing the trades with you. Whoever wants to take my trades, fine, you're invited. Lectures and mentoring. We had a lecture last week. Probably not going to do it for another 5 to 10 months. I don't know if I'm ever going to do it, because we're going to have actually a course that is going to be for sale, and we're going to have it up and running very quickly. It's going to be about position sizing, and I showed how you can make money if you're position sizing in this market. If you don't know how to position size in this market, you're not going to make money, especially in this market environment. So we have bonus. We're going to give you risk charts. We're going to give you guidelines and so much more with this.
Hey, Anka.
All right. So yes.
Sorry, I need to cut you off.
Oh, sorry. I thought I had 1 more minute. It's 3:59, but it's okay.
Oh, well,